jacket.
Welcome to Wage Cucking with JMO.
Welcome to another episode of Wage Cucking with JMO. We have Jordi Alexander here. Jordi, you want to give me a little bit about your background, how you got into crypto and what you're doing today?
Sure, yeah. So I also used to play poker. I wasn't as good as you, but played some high stakes cash games, mixed games mainly online. And 2011 kind of transitioned out of poker, did an MBA, and then got into trading, like high frequency algorithmic trading. And during that, I was hearing about crypto and getting tangentially involved. But I would say it wasn't until like 2020 I really got radicalized, mainly through like COVID and the Fed's response to COVID and thinking about, the big picture and first principles of like money and economics and the role that Bitcoin was potentially able to play as a balancing act for, I really felt the Fed was just a really shitty referee that was not letting a game play properly. Like when they started buying junk bonds, as an investor, if you short junk bonds, you had a very good reason to short junk bonds. Like the entire world, the economy is like grinding to a halt. And then you had the Fed step in and just decide that like, hey, we're just going to bail out junk bonds. So then once I got into Bitcoin, I'm a very like naturally kind of curious person. I want to like learn. So I just really got into like a 2x podcast phase where I would just listen to everything I possibly could. I think I absorbed like just, I don't know, hundreds and thousands of podcasts and pieces of information. And I guess that's what you call falling into the well. And I spun out of my TradFi HFT firm. I spun out Selini. Been doing that for over 2 years now. And we've been growing consistently in terms of market share, but also getting into other verticals like VC and like DeFi. And on the personal side, I've been doing a lot of kind of advising and also investing angel. So yeah, quite a breadth of stuff.
So the bread and butter of Selini is a market making fund or a HFT type trading fund?
The market making is like, we focus a lot on the technology. Like we want to have the best technology possible. And out of that, we start building the other. I find that to be like the most secure base. Once you're like extremely strong on that side, then you start building things on top. So the core is incredible tech HFT. And then you start doing, market making and cross exchange and providing liquidity and
Are there any like similarities or differences that stick out to you from like coming from traditional finance versus like trading these crypto markets?
I mean, microstructure is the same concept. Like microstructure is slightly different between markets. Like crypto has its uniqueness for sure. But thinking about microstructure and just, who's trading, where they're placing bids, the concept of like passive bids being like options, you're just kind of writing an option and you need flow to make up for that option. You need to make enough spread. So thinking about these things is the same. It's all the same. I would say that crypto is a bit more open in terms of entrenchment. Like in traditional markets, it's usually like someone has figured out a way to corner the market completely. Either they have like a microwave line between two sites that they have the absolute best microwave line that nobody else can match, or they have some specific deal with an exchange or something that doesn't allow anybody in. I think crypto has a lot of malleability and it's a more fun game as well. There's like always something new happening. This every week is different. It's crazy.
To me, crypto just like it changes far more rapidly, whereas like traditional finance has been the same for quite some time. So it just keeps you on your toes and makes things quite a bit more interesting.
Absolutely.
So the next thing I wanted to talk about, I listened to a bit of your talk with, I believe it was Algod Trading, and you guys had like a pretty intense discussion about GMX and dYdX and the sort of like the future of sustainable online trading. I guess go into a little bit about your position on like why the GMX model isn't sustainable long term.
So, when you have a model that you don't have two people trading against each other, I guess people that trade sports, maybe a lot of listeners have traded sports, like, you either bet against a sports book and they're taking the risk. And so you're dealing with them and for them, you're the product. Or you have something like Betfair where two people are being matched and then, the exchange is just like a neutral third party, just providing infrastructure and just matching people. So when you have Betfair model, you see like very good fees, like very tight fees, because the exchange is not having to protect itself against like smart traders. When you have something like GMX, there's sharks out there and they're constantly looking for arbitrage opportunities. They want to pick you off. If you're protecting, your investors, or in this case, like GLP, which is like your LPs, really, what you're having to do is charge crazy fees so that nobody can win, which is equivalent of a sports book kind of, instead of doing like, 195, they'll do like 180, 180.
Yeah.
They just have such a huge edge that like nobody can win. And that's kind of makes it safe for them. So the sustainability is that, so I either like you screw up and you get drained, and like you let the sharps like kind of trade against you and beat you, and then you lose and your business goes out of business, which would be the equivalent of like GLP going to zero, or you just keep fees really high. But then why would people use you if they have an alternative right next door? Like it's different if you're in Vegas and there's only like one option, but if you're online and you have like a jurisdiction to trade a place that has much lower fees, eventually people want to win, and they become more fee sensitive. So that's more sustainable in my opinion.
So for the listeners or watchers who don't know, GLP is the basket of assets within the GMX platform that the traders essentially trade against. So they have certain target ratios for certain assets. It's Bitcoin, Ethereum, stablecoins, and on Arbitrum, there are a few altcoins, I believe. On the GLP on AVAX has native AVAX. So like when you're trading on GMX, GLP or the LP providers are the counterparty, not necessarily like another trader. So I understand the issue with like toxic flow in these exchanges, but it seems like the traditional automated market maker model that has basically gained like the entirety of the market share has that problem. Like if you look at Uniswap, even like the Uniswap V3 and like the liquidity providers, it feels like a vast majority of them are losing and either are okay with the losses or don't realize the losses. So do you think the automated market maker model is also not long-term sustainable because of this?
It's sustainable for only two types of trading. One is like stable coin related thing, or stable swap type of trading, where you just have like an ETH and a staked ETH, or you have a USDC, USDT. Obviously, sometimes those depeg and we have fun. But the concept being that if you want like very concentrated liquidity and you want to provide people a place to swap those, an AMM is perfectly fine. Even something like Curve that has like, this very concentrated part there. That's really fine.
You're saying for like assets that are like essentially one-to-one like assets, so stablecoin to stablecoin, or like synthetic ETH to ETH or whatever.
Yeah, then there's not much ability for somebody to pick you off, right? Like you can totally use like concentrated liquidity for something like that. The other use case is very long tail assets, something that just launched. Somebody just launched a project. They'll put $1 million in $1 million USDC. So they'll just let people go wild. And, you can have like 1% fees on Uniswap for long tail assets. So you're getting a lot of fees and it's kind of like still worth it if there's activity and you can do really, really well.
Yeah.
So for those type of assets, I think it's fine. But for your like liquid, let's say like top 100 assets.
Yeah, like ETH USD or BTC ETH, something like that.
Yeah, for something like that. I think, the order book model is clearly the survivor of much evolution of traditional finance, and there's no reason to think that that's not also the best thing for those type of assets in crypto.
So the dYdX model, I trade a decent amount on dYdX, and I assume you do, like, or your firm does a decent amount of market making on dYdX. But the reason why it's attractive to me is because even though it's like a fully decentralized experience, it still links to a central limit order book, right? So you sort of get like a hybrid model of you're trading on a DEX, but like a lot of the issues that you have with DEXs, for example, like if you have quite a few validators, then your latency increases. And if you're like a big market making firm or a professional trader, like your edge goes down because of this. So do you see like more exchanges using the dYdX model in the future? Like, is that a long-term sustainable model? And right now, I guess dYdX is their version 4, I believe, is looking to move to their own Cosmos SDK. Do you see Cosmos taking off because of this, or is it the value just lying within dYdX?
I mean, there's a few things. I think, first of all, dYdX 3, which is what you're using and what's out there right now, I think is a great product. It works well. It's very low fees. They have even like rebates with the token as well. So there's token incentive, and they have years of runway for that. It's not going to run out. So it's a really good team in my opinion. We weren't investors in dYdX, but we are very active on it now, and we get a bunch of tokens every month, and it's incentivizing us to provide a lot of liquidity there. So I think it's a really good exchange. I think a lot of other new exchanges, the ones that we're most excited by on the venture side, are exchanges that are also order book based, that have good marketing. I think dYdX is a little bit corporate. It's not fully degen. Like they're kind of targeting a institutional-ish kind of crowd
for sure.
And there's other ones that are going for like the more retail kind of fun crowd. And I think some of them will really get it right. So we're talking to a bunch of them, and we're investing in some of them. That's like a very exciting vertical that I think is going to be like very exponentially growing. In terms of dYdX, they're in a unique spot. Like they have a ton of resources. They're by far the highest market cap DEX. Like they're at 3 billion. They've raised a ton of money. They're trying to do something incredibly difficult. What they're trying to do with Cosmos and this like V4 and the app chain, it's extremely difficult even for them. I think they have a world-class team, but I'm not sure how it's going to go because, like you've talked about before, having multiple validators keep track of the order book, and then having to be, let's just say, like good citizens, where they don't, like if a market maker is also running a validator and they just decide that, well, actually my order is in front of your order, and
conflict of interest.
Conflict of interest creates MEV issues, which you don't have right now in V3, because V3 is basically, all the matching is done off chain, and then they just kind of put the trades on chain. So they're thinking through how to solve it. We're trying to advise them on ideas, and it's extremely hard. The reason they're trying to do this is because that is the actual definition of decentralization. You want to decentralize even these things, but I think they understand that like social pressure is not enough. You have to make it decentralized, and you have to keep the validators incentivized, not just through like slashing, but maybe not even allowing certain things to happen. So hopefully it works. I think for Cosmos, it's obviously a big deal. You have such a prominent exchange saying we've looked at all the options, and we think that you guys are the place to be. It's high risk, high reward, but it's something we're definitely like interested to see how it turns out.
I wanted to talk a little bit about the dYdX token model, and I guess like tokenomics and things in general. So like one thing that initially was very appealing to me about the GMX model was the token model, the way that fees accrued back to the token, and that they have their own. Obviously, it's an emissions token, meaning if you provide GLP or if you use the platform, you generate the GMX token, but then they have like an escrow GMX system where your tokens aren't liquid initially, and you have to also keep your GLP position in order to unlock them. So it's like slows down the release of the token. dYdX obviously has like a bit more like traction or a bit more volume, I think. But their token model, I feel, is a bit basic. I don't know if basic is the word, but basically, as I understand it, it's purely like a governance token, but it's questionable how valuable the governance is. And it's like a fee reduction token, similar to some of the tokens that are launched on centralized exchanges, like the BNB token or the previous FTX
it's very similar to like Uniswap, right? Like it's basically a promise that at some point there'll be a fee switch, and in the meantime you're just kind of twiddling your thumbs. That's actually the reason for V4. dYdX V4 will allow them to have a fee switch or use the token for running a validator and actually have utility. It's otherwise, they're running afoul of like US regulation. They're all US based. This is kind of like a different story than GMX, who are, anons that are doing things in a different way. Obviously, people want their token to get part of the profit and have utility. And I think both Uniswap and dYdX are going the long way around, but they have a plan to get there. Their investors want them to get there, obviously, and they will most likely find a way. Like they have great investors like Paradigm, who have a huge legal team, and they're kind of guiding them through the way. And then you have GMX that are just kind of going for it. Here's your dividends. They're like 30%, and then 70% goes to the GLP, to the your LP side. I have respect for the GMX team in terms of what I think is an inferior model, but in terms of the Oracle model, they've done really well. They've also recently announced that they have like a low latency feed, which there's a lot of controversy because they kind of stole the idea from Synthetics, which is another competitor in that.
Yeah, it's sort of a competitor to what they're doing.
It's a competitor. and they came up with this idea of having like a low latency feed. Basically, a low latency feed is the idea that people can pick you off less well if you have a better like Oracle feed. It's faster. So like if the price moved on Binance, if you get it really quickly onto on-chain, it has less time for like, market makers to pick you off. So that'll eventually allow people to reduce fees because you'll be like more competitive. So there's improvements happening on that side. I still think it's not as good a model, but they are trying to improve it.
So going back to GMX, just wanted to ask this real quick. You think the biggest problem with the model is that it's Oracle based, meaning market makers can sort of pick off these trades? Or is it that like a larger percentage of the volume would be considered like toxic flow, meaning like the traders are sharp traders and winning, therefore the GLP holders are losing? Which of those do you think is like a bigger issue for the platform?
They have all these dials, right? Like they decide what fees to charge, and GMX has incredibly awful fees, not just for like the actual trading, which is 10 bips, whatever, but if you want to like go 30x long or 50x long, regardless of if you're going long or short, you're paying like a borrow fee, which is sometimes like hundreds of percent APY.
Yeah.
So imagine paying that like on like such a huge levered basis, as opposed to a centralized exchange or like an order book model where there's a funding rate, but if you're long, sometimes you're getting paid, or if you're short, you're getting paid. So both sides have a chance to get paid. On the GMX model, you're just getting rinsed. And one of the whales was telling me he went on vacation, the market was flat, and he came back and his GMX position was liquidated. just on like the borrow fees. Nothing else happened. Yeah, I would say like it's good for like a short-term punting. But if you actually want to do proper trading, it's different.
Yeah, that does make sense. So moving on, you're an advisor at Radiant Finance, which is I guess you'd call it an omni-chain lend, but like an omni-chain version of what like Aave or Compound is. You can deposit assets, borrow assets, stuff like that. So I just want to have a chat about like the state of decentralized finance, especially the token element to them. So you actually made a pretty good thread about the history of decentralized finance. So to break it down, like basically it started off with you just had like a lend borrow market and then like an automated market maker. And then you had like a governance token, an emissions token for people providing liquidity. They got a governance token. And then in order to pump the governance token or to add liquidity to the governance token, they introduced what are known as pool twos, which basically you pair your governance token with like assuming the governance token doesn't have much value, you pair it with like a real asset and you provide liquidity. And then those pools are incentivized. So then people provide liquidity, and it's questionable whether those pools make money or lose money. Like you see a number on the screen that says like 1,000% APY, but then you're also losing an insane amount in permanent loss during that time. And like, I feel like all those models died down a bit. And then, so like, I feel like these platforms were trying to figure out how to add value to their token without it being like the entire greater fool theory where they're just going to print a bunch, it's going to dump, and then their platform goes away. So that like I think you talk about like the sushi model, like the X sushi, where they basically provide a dividend. But like the issue is like the emissions of sushi were like way too high, and the trade fees on the platform weren't enough, so it didn't actually help that much in like keeping up the price. And then Curve, the whole Curve wars, basically, in order to protect the value of their token. If you see like Curve governance as valuable, you can lock your token on the platform. The longer you lock, the longer reward. The better rewards you get, but then like also like your lock period means you can't sell the token, which reduces sell pressure. And then I think Radiant's actually doing something like pretty interesting with their token. Basically, I feel like it's a combination of what like Curve is doing and like the initial pool 2 type thing, where you have to have a certain percentage of your liquidity in the Radiant token locked in sort of a pool 2, and like the rewards are high. But then if your ratios ever go below the threshold, that you lose rewards, and then it's sort of other participants in the ecosystem can sort of snipe your position by like when they notice that you're underwater. So do you see this token model as like a sustainable long-term model in terms of like not only the value of the token, but like the adoption, the number of holders, stuff like that?
So I wrote a Medium a couple of years ago called Of Smoke and Mirrors, and I really tried to kind of think first principles about DeFi and how all these things should be approached. And one of the key things is like think like in and out, and within a closed system, you just have like a fixed amount of like energy inside it. It's like there's like thermodynamics, and I try to apply that to DeFi. And just like SBF was talking about, like DeFi is a box and you put stuff in the box and you take stuff out of the box,
that was
whatever.
a pretty rough conversation. Yeah.
That was an awful supportive DeFi, and clearly he's not in his heart supporter of DeFi, as we eventually found out. But the point being, when you have a farming model, if you have farmers like Alameda that come in, put $1 billion, farm it all, and then dump it, you're taking energy out of the system, and it's kind of like the energy is like what your value is. And when you have somebody just farm and dump your token, it just goes to zero, right? Like we've seen that many times. They were doing it in huge amounts, like industrial farming. So a lot of these things that I've talked about in the thread are like evolutions of, let's lock up these tokens. Let's give some dividends so you don't sell it. Let's let you make governance decisions. There's different like layers of these things. So ultimately, we're learning and we're evolving and we're making better mousetrap. I don't think that's sustainable or not sustainable. I think ultimately you need to have a good product that people have fundamental desire to use, and then the rest kind of lets you bootstrap it. So like these ways of like only giving, like what Radiant does, for example, you only give a good amount of farming rewards for people who are not able to just dump your token. Like they're kind of sustainably providing liquidity and like the protocol on liquidity pool in a way. At least you stop the predatory people from just sucking out the air. And that gives you some space to like build something. And then hopefully what you're building is actually useful and good. So, adding cross-chain capabilities, using layer 0, it's an obvious thing, right? Like, of course, that's like what we were thinking about a year ago, 2 years ago, is like somebody should do this cross-chain. It shouldn't just be like Aave compound on one chain.
Yeah.
So they're starting to build that and like add more chains. It's, it's a long road ahead. I just recently became an advisor, and the main reason was I like to work with projects that reach out to me and say like, hey, like we're reading your stuff. We actually want to be sustainable. Can you help us design things to be sustainable? And that's kind of like the advice I recently have started to kind of give them and put them on that path. So I think they're doing some interesting things, and ultimately they have to make users want to use their product instead of Aave, and then everything else kind of adds on top of it.
I definitely agree with that. Like the token model can only go so far. I think the bottom line is there's no way around getting a large user base, like a large following, a large amount of volume, and then like once you have that going, you can sort of like cater your token to like what's going on your protocol and how you see it sustain long term. But like even if you have the best tokenomics in the world, if you don't have like a user base that's there long term, it doesn't really matter.
Yeah, I mean, let's look at other examples, right? Like Blur, for example, they did a very similar thing where they used very clever tokenomics to give them a chance. Just give me a chance, man. Just they started vampire attacking OpenSea because they created like this multi-generational like airdrop period. And because their product is actually good and people do like using it, they have managed to sustain and keep a lot of the volume away from OpenSea. And they've grabbed what's most important in crypto, which is attention. That's the scarcest resource. We're all being kind of pulled in different directions. So ultimately, you want to use your tokenomics in a way where you get attention for enough time and you build a good product, then it all comes together.
So one thing I was curious about with Radiant, if you have a take on this, is so Radiant is a borrow lend market. You can deposit one asset, use that as collateral, borrow another asset. You get paid fees on your deposits, and you have to pay fees on your borrows. So it's similar to like any other market. And I've noticed a lot of these similar platforms have done this, but it's essentially what they're doing is they're incentivizing both sides of the borrow lend, right? So like there's certain APYs for borrow and lending, but they also release a native token for each. So at some point, it becomes profitable to deposit collateral, borrow, redeposit that collateral, borrow, and then like loop it over and over again in order to grind out. And I never really understood this model in terms of how it adds value to the platform. I guess in my eyes, on paper, it just inflates the TVL of the platform, right? Because like if you're depositing, let's say like $100,000 but if you loop it like 3 times, your deposit looks like $300,000. So then like if 10 people do this, you're at $3 million instead of $1 million. And then your platform gains a bit more credibility, I guess. But I don't know, do you have a take on this as to why this strat is implemented by protocols and if it actually adds value to the protocol?
Yeah, I mean, this is something that's been around since the beginning of like these type of protocols, the Aves and compounds. And like you said, when the rewards are high enough, both sides, then it's actually profitable to keep looping. You can't do it infinitely because it's usually like a 90% and then 81% and 72%.
Yeah.
But you can do it like several times. And I mean, Radiant just makes it transparent. You do one button and you don't have to keep clicking. I remember like when I was farming during like 21, it would just take hours to keep clicking through. And then you can keep doing it infinitely, right? Like you can go from like 91% to 82, 73, 64. And at some point you just decide like, okay, I'm going to make an extra $89. Is this worth my time to click again? Like, okay, now I'm going to make 60. Like, when should I stop clicking? Like, it's kind of dumb. So they just, they just zoom it through. Basically what you're doing is like, yes, you're increasing TVL, but in reality, you're taking on more risk of liquidation because if the thing starts moving against you, the more times you loop it, the less like kind of space you have to be able to sustain movement. So you're taking risk, and in exchange, it's kind of like UniV3, like you're putting your liquidity in a more concentrated space, but then if it moves outside of that, then you're kind of screwed. So it's the equivalent of that. That's part of the risk that you decide to take, and you can choose where to dial that in.
Outside of Radiant, are there any projects in DeFi that you're advising or like you're especially bullish on that offer something unique to the current DeFi landscape?
Yeah, I mean, like I mentioned, I'm a very generalist in many ways. Like when I was playing poker, I wasn't playing limit hold'em. I was playing like 50 variants of poker. I like kind of going across the board. So I advise projects in all verticals right now, some of the major ones. If we're looking at borrow lending specifically, the thing that I constructed a couple of years ago, I put out a thread just to the world. And I said, guys, like if I'm thinking about this from first principles, I don't want liquidations, because if an oracle screws up or gets exploited and I get liquidated, I'm actually like completely destroyed, and it's not worth me getting a little bit of TVL. So what I put out there was non-liquidation borrowing. And then a lot of projects started building that and asking me to advise them. And some are already launched, some are like launching soon, some big ones are launching as well. And the basic idea is using a put option that's kind of priced by the market. Okay. You don't need an oracle, you don't need liquidation. So just very simple example, right? You have Ethereum and you want to borrow some dollars. Let's say ETH is 2K and you want to borrow like $1,200, so 60% of that for 3 months. So there's a very nice way where we don't have to like liquidate you or check an oracle and whatever. We can just say, okay, here's $1,200. Here's like the interest that I'm expecting. And if in 3 months you don't come back and pay me the $1,200 plus the interest, I'm going to keep your Ethereum. So the reality is you might not show up, because if ETH goes to $900, like we saw, like, for a brief moment last year, you're not going to come back and like pay me like 1,200 plus interest. Yeah, that's the risk I'm taking. So in a way, I'm like writing a put option. In exchange for that put option, I just charge you a little bit more upfront. So you're using options in a very clever way to avoid the risk of oracle exploits. Yeah. And I think you can sleep at night without worrying, like when you wake up, like what did the oracle do? So that's there's a couple protocols that I'm advising on that. One's called Valent. It's going to come out soon. Another one's MISO. That's kind of like in a test phase right now. That's also really good. Yeah, that's pretty cool. Are the put options like priced in a way? Like is it a market like bid ask for the puts, or are they priced by the platform? It's in the interest. So in a way, like it's up to the market maker. They can say like, okay, my risk-free rate for dollars, if I'm just lending out, is I want 10%, but then I'm also want like a 3% for the put. So I actually want 13%. And you as an ETH holder, you're paying 13% instead of 10%, but you're also getting like the downside protection, and you're avoiding like oracle exploits. So that's kind of how it works. Yeah, I actually like the model quite a bit, because it avoids quite a bit of the issues that come with liquidation as well. If you look at like a lot of the smaller to medium-sized borrow lend platforms, a lot of their issues was they have like 1 or 2 positions that are like from whales that consists of quite a bit of their total value. And then especially if it's like a position in like they're depositing an asset that isn't necessarily super liquid on chain, they sort of need to figure out how to liquidate it if it comes to that point. And a lot of the times it generates bad debt for the platform. Like I think the biggest example I can think of was when Solana was going down, the Solen whale, who had I want to say like 80 million, like something like
5 or 10% of the on-chain Solana deposited in this one market, and he was close to liquidation, and they were scrambling real hard to figure out how what they should do, because if his position went to like the coded on-chain liquidation, then like their platform would be done, right? It's like they would have like this insane amount of bad debt, and it would also drive down the price of like the on-chain markets of Solana. So yeah, it's definitely an interesting take as to how to have these markets not be reliant on like on-chain liquidity or oracles. Yeah. I just want to talk a little bit more about the future of DeFi. Going back a bit to like the whole GMX versus dYdX versus automated market maker debate. What models do you think people will be using with like, I guess the biggest volume in the future on chain? Like, what do you think the future DEX model is going to be? Is volume still going to reside with like the Uniswap traditional automated market maker model, or is there going to be like something else that sort of takes over market share?
I think something else is going to take over market share, and I think it's also going to take market share from centralized exchanges as well. I think we're already seeing that. Like, I think we've already gone from maybe like 7% to like 12% of derivatives market being on chain. I think that can grow a lot more. You don't really need a centralized exchange when you can do everything in a decentralized way. What centralized exchanges allow is like marketing spend, and they can hire marketing teams, and it's hard to do that with a DAO.
Yeah,
they have that a bit more focused, but it's not that hard to do. Like dYdX, Synthetics, a lot of these like DAOs that I work with, that I advise, even like, we're on the board of Synthetics as well. They have like proper ways to give funds to, people doing podcasts or people doing different things, and sponsoring them and creating, the equivalent of what, a Binance or FTX or Bybit, whatever would be doing. So very bullish on that side. I think in terms of like what kind of model exactly, we see that in poker as well. Like you'll have the casinos that are open and everybody can play, and then you'll have like these private games that are, OTC type of markets, or just like the fully like degen casinos. Like GMX, I would say, is kind of on that side. We saw something like Rollbit. I think they're in trouble now, but they were offering like 1,000x leverage, like literally 1,000x, just taking it to the extreme. And obviously people don't care about fees, and people are just taking a punt.
They're just gambling. They just need an outlet to gamble.
But like, you and I both know that gambling is intertwined with the financial space. And I was talking with I just remembered Matt Wong, the founder of Paradigm, and he has this thing on his Twitter, like his pin post is like, there's like a Trojan horse, the meme of the Trojan horse, and there's like a casino, which is like crypto, but inside the Trojan horse is like a new financial system, and that we're kind of using this like casino to bring in a new financial system. And I kind of made the point to him, like, I think there's not like an outside the horse and inside the horse. I think the financial system is a casino anyway. Like it's all the same thing. Like it's all intertwined. Like you can't really differentiate it both. And I've been in traditional finance for a long time, and I've seen all the ways in which that's often a casino as well. And you are providing real world services at the same time, but you can't differentiate where does one end and where does one stop. So there'll always be users that are just trying to gamble, and that's human nature in a way. Like people are just hoping that they try their luck, survival of the luckiest. I mean, we see that with like the Korean markets as well. Like the kind of coins that they're buying over there are not necessarily, they can buy Bitcoin, but instead like they're buying Bitcoin Gold ABC or something. Like they just want to take a punt. So we have to respect that and accept that that's always going to be a part of the market.
Yeah, that makes sense. There's always someone looking to gamble with leverage and like risk it all to make it big or go home. So going back to DeFi, so like protocols like Radiant and other stuff powered by like the layer 0 technology, so sort of makes interchain communication quite a bit easier. Do you see this as like a thing in the future where there will be like a bunch of like layer 1s operating independently that can communicate with each other, or do you see it more concentrated, like the liquidity concentration, like say all moving to Ethereum and Ethereum layer 2s, or maybe like if Cosmos really takes off, like alternate chains on Cosmos? Like how do you see the future of liquidity in terms of like providing liquidity as LP or trading in the decentralized ecosystem?
So I'm a believer in like multi-chain, and here's why. Like if you think about like Ethereum and like smaller chains, like new chains, as a believer in Ethereum, for example, and as a, if you're pumping Ethereum, you're doing a service to everybody in a huge community. And in a way that's very altruistic. And, if people are supporting Ethereum, we don't like shit on them because it's,
Yeah.
they're pumping everybody's bags. Like everyone who believes in smart contract technology has some Ethereum. And so those are people who are considered legit.
Mhm.
And if they instead are like trying to like shill a smaller L1 or a new one, there's like a negative connotation. And when you think about it from like a human perspective, in the one side, they're not being greedy because they're trying to pump for everybody. And on the other side, it's possible for them to have like a really large piece of whatever that is. So
Yeah.
they're being more kind of like selfish. And that's true, like just from incentives wise.
Yeah.
But the reason I believe in like the multi-chain world is, incentives is everything. And Ethereum cannot just give you Ethereum tokens. First of all, it's deflationary. There's barely any to give. They can't just say, okay, if you're building a new project, like a new like cool app, like a step-in or whatever it is, come to Ethereum and we'll give you like there's no like way that they can incentivize you because it's decentralized. It's already all out there.
Yeah.
But if you have like a new L1 that has like really good performance, I kind of see it as like I like the Haseeb's like thesis of like cities, because in a way like you can incentivize people to move to your city, just like Amazon was like trying to move to New York, and they were like looking for like who's going to give them better tax incentives. They kind of put everybody against each other. When you have an alternative L1, you have the capability to like negotiate incentives a lot more aggressively because you can just give them like, and they're adding value to your city, right? Because they're coming and they're building like jobs for everybody and creating activity. So I think Alt ones will always find ways to use that advantage, and having ways to communicate between blockchains is going to be part of the core infrastructure.
Do you have any take on so like I say right now, Ethereum is probably like the biggest player in the space, right? Like by far the biggest market share, the largest number of users. Obviously, alternate chains have like the treasury in order to incentivize people to build on their chain. But I feel like alternate chains have also like some technological advantages over Ethereum. And like we just like look to the example of Cosmos versus Ethereum and dYdX potentially moving their V4 from like an Ethereum rollup to Cosmos. So like Ethereum is I think they call it like a shared state machine, meaning like if there's activity like elsewhere on the chain, if there's like this massive NFT mint that like brings like 1 million new users that are clicking buttons like all day, then that affects like every app on the chain. Whereas like on Cosmos, like you essentially have your own chain and like all the chains communicate with each other. And then you have stuff like Polkadot, which is like sort of a similar approach, like a modular chain that they have. I think it's called inter-blockchain communication,
right?
Is what they call it. But it's sort of similar to what ETH was attempting to accomplish in their initial roadmap, where they wanted to the final stage of the ETH 2.0 or whatever you want to call it is to implement sharding. And it sounds like if you read through their roadmap right now, they've sort of given up on sharding, and they're saying that the layer 2 ecosystem is how we're going to scale Ethereum, and we're going to just use Ethereum layer 1 as like a settlement and base layer if fees get too high. So it to me, it does feel like there are competitors out there that not only can provide incentives, but actually offer like a tech stack that is superior to ETH. You have any thoughts on that?
No, I agree. It's just a matter of like experimentation, right? Like we see that with Bitcoin as well. Like, you don't really experiment with Bitcoin. You put stuff on other chains, and then maybe like 10 years later you kind of implement it. And the same thing with Ethereum. Like getting to proof of stake on Ethereum took forever. And then you already had like 20 chains on proof of stake already. So I think some of the new ones will start to shine. There's things like Monad that's going to be coming out that is really trying to like be like a much faster and better version of an EVM chain. We'll see which ones work out, but I think, like you said, there's a very slow moving Ethereum at this point that needs to do everything properly. In terms of sharding, it's strange that they gave up on it. Like Near has done sharding, so it's not like it's impossible. But I think in terms of like centralization and maybe some of the decisions that they took make sense in a way. But there's always like pros and benefits to any decision, and that's why like Cosmos, for example, I think will have a role in the future as well.
One final question before I let you go. So I noticed you tweeting like a few times about Aptos, saying that like the value of Aptos won't be as high. And I've had like I guess like since the launch, I've had like sort of a bullish take on Aptos. Like I think the technology is like pretty legitimate. it's like the first move chain to actually go to market. There was like at least a decent user base from day one. Like I understand the bear case for it is like it's hugely VC invested, and like its fully diluted valuation is insane. Yeah, I just wanted to hear your takes on it. Is it just that you think that like it's more marketing than anything else? Like the Koreans are buying because they think, well, one Aptos is one apartment or whatever the meme is.
I mean, I would say it's not like specific to Aptos. What we realize in general is that any crypto token is overvalued. All of them are overvalued unless you consider the money use case. Then I think actually Bitcoin and ETH are undervalued. But everything else, so you have kind of like a few categories of coins. You have like meme coins that are just hot air, but they're worth tens of billions of dollars, like Shiba and Dogecoin, all these things.
Yeah.
So can't say they're not overvalued. Then you have like things that have legitimate things like Lido, for example, or dYdX. But if you look at their revenue, it's still a huge multiple. Like, for example, Lido is like a 70x P ratio. So even like the legit stuff, because there's not that much legit stuff, it gets overbid because like the legitimate funds have to buy it. There's nothing else for them to buy. So, and then you kind of look like things like Aptos and Solana, where, the gas of what's being used is like minimal. Yeah. It's like nothing. Yeah. Like this thing, like, why does it have any value in general? It's kind of this long-term optionality that maybe something will happen. But the main story for me is that clearly like people want to buy tokens. There's like a huge demand for tokens, and it actually outstrips supply for tokens. And whenever anything gets attention and gets like a narrative or gets like a localized, part of the world really into it, like, XRP is another one that, Koreans like apparently like that's like their favorite coin. Yeah. It's like the top of the charts. Yeah. It just takes a life of its own. And, I don't judge it. I'm open-minded and I try to understand, what the long-term viability of these things are, but I'm also like not jumping into the train. And I think at some point, like there's like a shinier object, and yeah, it's like a move chain, but Sui will before long be out. And it's the same thing with like Arbitrum. Like right now, Arbitrum is like the prime L2, but maybe in like once all the ZK ones come out, like in a year or two, like there'll be some other ones, and who wants like the old one at that point? Like everybody, new coin, good, right?
Yeah, for sure. And it's also questionable, like even if Arbitrum like is the premier layer one in a few years, well, what the value? I mean, like I understand that like Solana and like Aptos, like you essentially don't pay fees to use the chain, so like the value accrual is kind of questionable for the token. But then like something like Arbitrum, you're not even using it as a fee paying token, and then it's a governance token, but like governance doesn't really work in like an Aptos as we've seen in the past. So like it's sort of questionable. So like a few episodes ago, I had Dave from Chronos Research. I don't know if you're familiar with them, but they're like pretty big market makers. I think they're actually the biggest market makers on dYdX, and he works with Woo Network as well. But he comes from a traditional finance background, and I just had to talk with him, and now he's getting into more of the VC side of things on like the crypto space. So I had to talk with him and like ask them, what are the differences between like traditional finance and like, especially in like the venture capital side of things, especially you're looking at like these token deals and you're investing a lot in these token deals. Like, how do you like, you have a general thesis, how do you value these tokens, especially like the ones that don't really seem to do anything, but seem to accrue value? And basically what he was saying is he like his experience from trading like the traditional markets like set him so ingrained in like traditional metrics of how to value a company. And then at one point he was like shorting Tesla because it was obviously overvalued on paper. He was shorting like GME, he was shorting AMC, and then like eventually he lost enough money doing that like he realized that there's like this new paradigm where you can't really judge like tokens or equities or like whatever now based on like their inherent face value, but there's always going to be like some like community factors, some meme factors, something that adds like anywhere from short to long-term value to this asset. That like the more like traditional people that take traditional approaches to investing in finance will like never be able to identify. So it feels like that's sort of going on, at least in the crypto world. Like even today, like I log in on my computer and I look at like the coins pumping, and it's like a Pepe pump and dump, and people are talking about should we be buying this for the memes and stuff like that. So it seems that like the whole meme economy seems to have some like long-term staying power in the space.
Yeah, I mean, I think it kind of falls back to the power of attention and how valuable attention is. And we forget, like, if somebody has like 100,000 followers on Twitter, that's like more than like this gigantic stadium you're seeing on TV, where like, all of the city came up to watch a match. It's a lot of people, and having the attention of, hundreds of thousands or millions of people collectively just like is like quite a big force, right? So Tesla, like, you have Elon just reaching half the globe probably, like when he says something. And actually I watched the episode, and I agree that what happens in a lot of these cases is that like the attention grabs a lot of resources, and then if somebody knows how to use the resources, like Elon was pretty good about using the resources that people were basically buying Tesla stock, so then the company was selling more and more. They get all this dollars, and then maybe they make really good investments with it. Maybe like they do something clever with it. And even if initially the thing was like undervalued, once you get all the resources, if you use the resources right, then maybe you actually create something. And we've seen cases of that. So we can't be like too harsh to judge things. Although, with like things like Shiba, like they start building Shibariums and layer twos, and
a little like DeFi, like NFT platform type thing. I mean, I guess it's better than nothing, right?
It's better than nothing, but some things you still need someone like very creative, like an Elon or somebody kind of that's gonna do something different and actually use the resources in a way that will create like much more aggressive. Like if someone's shorting your stock, you want to like put the fear of God in them. Like you want to like do something like really kind of where they read the headline and they're like, oh shit, I'm screwed. Like this thing's going to pump even more. And then they have to cover their short. You want to do that. And if it's just like doing random kind of initiatives that everyone's done, build another DEX and whatever, then let it go to zero.
It's also kind of fun to be part of the community, like on the other side of the trade, right? If there's like a company or a stock that is like there's like a big fund obviously represents like the institution or like the traditional wealth shorting a position, and like it's a like their position is out in the open, and then you have like communities like 4chan and like Reddit and like people on Twitter just like individuals ganging together to take out like the big institution. It sort of like forms a sense of like bonding, a sense of community that they're doing something productive, which I find kind of funny.
Yeah, I guess it kind of, like you said, it takes us back to our caveman days. Like it's like the whole village going out and trying to bring down the woolly mammoth or something. Like it kind of creates like this mindset. And it's entertaining, for sure.
Yeah. So before I let you go today, I guess just let the listeners or watchers of this show know where they can find you. If you like put out any content, like where they can read that at, like maybe if there's anything upcoming you want to promote or shill, go for it.
I mean, my Twitter's where I'm most active when I have time. It's at Gametheorizing. I do want to write more mediums. I have a medium where I write blogs sometimes, and that's probably the best bang for buck in terms of like evergreen content I try to put out there. Otherwise, like I would say like I'm increasingly wanting to be a bit more in the arena now than just kind of being a sofa critic and just kind of judging other people building DeFi stuff. So I'm increasingly like getting into the game and trying to design things, and I guess I want to kind of take the Andre Cronje route of trying to actually build some things, and I have a lot of ideas. Build some product. So I'm kind of looking to maybe collaborate with a blockchain and help build some of the primitives. So there'll be some stuff coming out later in the year that you'll see.
Cool. Well, I think that's all we have for today. Thanks for coming on.
Absolutely, it was fun.